Today, I'm going to be sharing insights into a common mistake that applicants often make when seeking a mortgage loan. It has to do with their down payment. Let's dig into it. Borrowers often have a lot of questions when it comes to the down payment used for the purchase of a home. Do they need 5% down or 10% down or 20% down? Does it matter? Does the money have to be from their own savings? Can it be gifted? Who is eligible to gift it? Can it be borrowed? Can it come from overseas? How long do the funds need to appear in my account? Those are great questions. The answer is going to depend on your property price and the policies of your lender. The standard down payment in Canada is 20%. If the purchase price of your owner occupied home will be under $500,000, you can purchase default insurance and get the down payment requirement as low as 5%. If the purchase price is up to 1.5 million, you'll purchase insurance and get the down payment minimum closer to 10%. And to avoid the insurance premium, you will need to put down 20%. Most lender likes it when your down payment is coming from your own savings, since it shows that you're a strong borrower. But many lenders will allow some or even all of the down payment to come in the form of a gift from a parent or close relative. Gifts are not obligations, so there should be no paperwork or expectation from the giftor of getting repaid by the applicant. Otherwise, it will be considered a private loan, and borrowed funds are typically not permitted to form part of the down payment. One mistake that I often run into is clients will create a new savings account and then transfer investment sale proceeds, savings, gifts, bonuses, commissions, and transfer from spouses into that account. That type of pooling actually makes it much trickier for the bank underwriter to evaluate the funds. The underwriter's job is to track the history of the down payment over the course of 90 days. So if it's coming from income received as part of your paycheck every 2 weeks, she'll want to see the bank statements showing how much your income and expenses are each month. No need to pool the savings into a special account. Another mistake that clients often run into is not having enough down payment for the property that they already made an offer on. If things are tight and you're going to ask your parents for a gift, it's best to have that conversation with them early before you even start looking at properties. If mom and dad live overseas or your savings are coming from an overseas account, most banks will allow this, but some will want to see the money transferred into your account 30 or even 90 days prior to the purchase closing date. So it often depends on lender policies. Fortunately, when you work with a mortgage broker like me, we can cover all of these scenarios during our planning meeting so that you can go out into the market with confidence while avoiding painful down payment related surprises during the closing stages. To book your meeting with me, visit themortgagespecialist.com.